Picture this. Last week Brent Crude suffered one of its sharpest drops in months, tumbling heavily despite supply disruptions that would normally send prices soaring. Yet this morning, the market is frozen. Rabobank has just published a note titled Brent, Cautious Trade with Geopolitical Risks, and the message is clear: nobody wants to bet too aggressively. The reason is that while the charts look bruised, the Strait of Hormuz, a narrow waterway carrying roughly a fifth of the world's oil, is sitting on a geopolitical knife edge. Traders are trapped between a price plunge that suggests demand fears and a war risk that could cut off millions of barrels overnight. That contradiction is the story of today, Monday the 10th of August, 2026. Let's rewind 6 days. Brent crude and gasoil prices fell sharply, a move that stunned many because it happened against a backdrop of ongoing supply threats and elevated geopolitical anxiety. You would expect a risk premium to hold prices high, but it evaporated. Why? The clues lie in the broader market chaos that Rabobank strategists called several economic shocks unraveling, including trade disputes, policy uncertainty, and a U.S. government shutdown that has made key economic data unavailable. Without reliable crop and energy reports, funds pull back. At the same time, global investors are bracing for a possible meeting between President Trump and other world leaders, leaving liquidity thin. The sell-off was not necessarily a verdict on oil supply, it was a flight from opaque risk. That context matters because it means last week's drop may overstate true supply comfort. The fallout is rippling far beyond oil pits. The Australian dollar is under heavy pressure, losing ground as safe haven demand lifts the US dollar. Heightened US-Iran tensions and the constant Strait of Hormuz risk are driving investors into the greenback, punishing commodity-linked currencies like the Aussie. For everyday people, this means imported fuel and goods could become more expensive even if headline crude holds steady. Rabobank's note today underlines that cautious trade is the rational response when a single incident in the Gulf could spike prices by 15 or 20%. Meanwhile, Iran International reports that conflict fears have repeatedly lifted both oil and gold this year. So the market is pricing a small probability of a catastrophic event, and that small probability is the only thing stopping Brent from testing much lower levels. So where does Brent go from here? Rabobank's technical assessment, part of a global energy daily just days ago, shows Brent remains constructive as long as it holds above support near $83 to $84 a barrel. Resistance is clustered between $86 and $88. Today, with prices hovering cautiously just above that support zone, the market is effectively sitting on a trapdoor. If US-Iran diplomacy delivers a breakthrough, that geopolitical floor could vanish and we could see a swift test of the low 80s. On the flip side, any confirmed escalation, a tanker seizure or a naval skirmish in Hormuz, would almost certainly blow through the $88 resistance and bring a rapid repricing. Rabobank's note is a timely reminder that in an environment where data is scarce and headlines are explosive, technical levels become the only anchors traders can trust. For the rest of this month, the Brent story is not really about supply and demand in a textbook sense. It is about the premium that investors attach to uncertainty itself. Rabobank has handed you the map. $83 to $84 is the line in the sand, $86 to $88 the lid to watch. Behind that sits an awkward truth. The oil market is being shaped less by barrels than by binary risks, a shutdown in Washington obscuring vital data, a waterway in the Gulf that could become a war zone, and a dollar that strengthens whenever fear spikes. If you are trading, hedging, or simply filling up your car, recognize that the next big move will likely be headline-driven, fast, and unforgiving. Stay nimble, watch the strait, and do not mistake cautious trade for calm.